British American Tobacco is a company that is down 47% over the last 10 years. However, we note a double buy rating from Seeking Alpha analysts as well as Wall Street, and this is also a company that offers a dividend yield nearly at 10%. So is it a strong company that's undervalued to add to our portfolio with a very nice yield? We're going to find the answer in today's episode. We are going to do a deeper dive. We're going to get up to date with the latest numbers, their top line revenue growth as well as their bottom line net income. We also want to find out how safe this company is in terms of the health, total cash versus their total debt, to understand the dividend safety. We're also going to look at the dividend safety score, which is borderline safe, to understand if there are any potential dividend cuts that could be looming for this company. As we can see on a forward basis, the yield does sit at 9.45%, and we'll also look at both insiders as well as institutions to see if they have been buying or selling this company over the more recent quarters. And there are a few things that we do want to point out from their latest conference of March. Lots of key information like their forward guidance as well as their performance. And ultimately, we want to get to the valuation model. What is our intrinsic value of BTI? What is our acceptable buy price given our investor margin of safety? And do Wall Street see some nice upside with this high yielding company? So let's jump straight in, and we will refresh ourselves with this company's performance. Now, over the last 10 years, it is down around 47%. Just over the last 12 months, however, it is down around 5.81. Although what we can see year to date, it has been fairly positive. It is up nearly 8%. Now, in terms of the 52-week range, we do note it is pretty much bang in the middle of that point. And as we did say, the yield is looking very nice, and on a forward P basis, it does sit around 6.7 with a double buy rating. Now, typically what we want on this top line revenue growth for the companies we analyze is 3 to 7% growth year on year as a baseline. 21.8 billion reported in 2014. 35 billion in their latest annual report. So we do see some nice growth over the last 10 years. When we do look at it on a graphical basis though, we do notice some inconsistencies year on year, and in fact over the last few years in the more recent period, there has been marginal growth to their top line, something we can look at when we consider them on a percentage basis shortly as well. How about the bottom line? Well, in fact, we do note their net income has gone from around 4.8 billion in 2014 to a loss of around 18.3 billion in 2023. Now, the reason, as we can see, for this loss in the more recent year, a non-cash impairment charge around 31 billion. It doesn't affect the free cash flow as it is a non-cash impairment, and this would have ultimately been sitting there around 13 billion, so it would have shown growth from the previous year. However, when we do take a look at it on a graphical basis, their bottom line, similar to their top line, has been inconsistent over the last 10 years. In terms of looking at the health of the company, remember total cash versus total debt, 2.9 billion in 2014, 6.7 in their latest quarterly report. So in fact, it has more than doubled over the last 10 years. And the trend of their cash over the longer term has been increasing, which is very positive, especially given this is a company that does pay a very high dividend. But as always, in isolation, that number doesn't mean anything. Always good to compare it to their total debt. What we can see, 19.3 billion of total debt in 2014, 51 billion in their latest quarterly report. So that is a very large debt position. It has increased significantly. When we do take a look, however, we do note from 2017 where it did increase dramatically, they have started to pay that down year on year, which is a positive sign. Hopefully that trend does continue where they are lowering their debt. That will also help with that dividend safety that we will come on to shortly. Now, one thing that we do want to have a look at is their earnings per share estimates. Now, in 2024, they're anticipating around 471. Just bear in mind, we will be using this for one of our valuation models. This gives a current forward P of around 6.71. 2025 anticipating just under $5, as we can see here. Forward P of around 6.34, which does look very cheap. And when we do compare it to others in the valuation model shortly, you will note that this company is trading at one of the lowest forward Ps in the industry. Then when we take a look at some of the underlying metrics, the first one is the valuation grade. As we can already see, a very strong grade, A+. So in terms of valuation, this is looking very cheap. Now, as we just mentioned literally seconds ago, the forward P 6.7 on a non-GAAP basis when others in the industry are trading at around 18. So you are getting a discount of nearly 63% on the industry for a very high quality company in the tobacco sector. When we take a look, there are other valuation methods as well that if you do want to use, for example, the price to cash flow 5.15, others in the sector on average around 12.1, again another nice discount of negative 58%. Different investors will look to use different methods, different valuations as well. You can see them all here. Overall though, they do get a very strong A+. In terms of looking at other methods, so then we move on to the growth grade. Now they do get a D. Reason for this, their top line growth year on year negative 1%, when others in the sector just above 2. When we look on a forward basis though, they are anticipating just below 2%, when the sector as a whole around 4%. And there are other methods as well. The one that we do want to point out is here the earnings per share over the next 3 to 5 years is anticipated to grow around 5%, whereas others in the tobacco sector are looking around 8.25%, hence why they do get that D rating and an overall growth grade of a D. Then we move on to their profitability, so we have another A+, very, very strong. That is made up of several different profitability metrics. The first one, the gross profit margin, 82%, significantly higher than the sector median of 35%. Bottom line, however, this is slightly skewed given the fact that the year we just discussed, 2023, did have that non-cash impairment charge around 31 billion. Does affect this number. We can see though the sector as a whole 4.79%, and we can look at this metric for the last 10 years shortly as well. In terms of others though, one that we also like to point out, cash from operations just under 14 billion, as we can see the sector median around 752 million. So overall, in terms of the metrics, firstly a double buy rating with a hold from quant, A+ valuation, D on the growth, and A+ on the profitability. Now how have they performed against others in the industry? We're looking at the likes of Altria Group, Japan Tobacco, Imperial Brands, lots of these that we have covered already on the channel. Over the last year, total return including dividends reinvested, BTI is pretty much flat. It is up just around 1%. As we can see, Altria, one that a lot of people do compare this company to, is up around 9% on a like-for-like basis. When we expand this over the last 5 years, again, BTI up around 20%. We see the very close competitor Altria around 28.5%. And when we expand it over the last 10 years, in fact, BTI is down around 5.5%. So if you've been reinvesting these dividends, the very high dividends, in fact, over the last 10 years, you would be down. If you were doing the same for Altria, you would be up around 105%. Granted though, bear in mind past performance isn't an indicator of future performance, just something that we do like to point out on the channel. Now typically we do look at insider movement, whether they've been buying or selling. We don't have any information to show you as there hasn't been much on show on the record, but what we can show you is it has been heavily traded by the likes of Daniel and Virginia, US Congress members, both buyers and sellers. Not something we incorporate on the channel, just thought it'd be interesting to share as we typically do show this anyway on other stocks. But again, we typically like to see insider buyers as we do see that as a bullish signal. Insiders typically buy. They believe the share price will go up, but we also do show if there have been any insider sells. Nothing to report on this. However, when we do take a look at institutional ownership, over 21%, 21.44%, we see 673 million worth of sales by the institutions over the last 12 months. We do see a little bit more buys over the same period, 845 to be exact. Although what we do want to point out, in the more recent quarter, Q1 of 2024, there was a little bit more selling than buying, 67 million versus 46. So yes, over the last 12 months, more buyers than sells. However, in the more recent quarter for BTI, institutions have been selling more than they have been buying. Now, we also just want to let you know, we have released our latest free weekly article, 20 undervalued dividend stocks to consider for the portfolio. Completely free if you want to read, instant access as well by clicking on the pinned comment below, as well as these other articles, all completely free. If you do as well want to read this one, how to find undervalued stocks, we do run through all of the websites and articles that we use to value stocks on the channel. Now, before we dive into the dividend safety, the potential dividend cut as well, we just want to run through the Global Consumer and Retail Conference that they had a couple of months ago. Lots of interesting information if this isn't one you have taken a read of. First one that we do want to point out is that their new categories, which is part of their income stream, they are now profitable, and that is 2 years ahead of what their target was. So that is very good news for this company, for management as well as the shareholders. And also another thing is that they are continuing to have strong cash flows, which is very important. As we can see, one of their pillars are to continue to reward shareholders through their enhanced financial flexibility. We're going to take a look at a little bit more of that now as well. So in terms of how they performed in FY23 in comparison to the previous year, we can see they are up around 3.1% from the previous year, and on average over the last 5 years they are up 4.2% year on year, so that is a positive amount. Remember, we do want to see 3 to 7% and 3 to 4 as a bare minimum. Reason for this is just to keep up in line with inflation. In terms of their operating profit, well, up 3.1 on average 4.8. So what a trend that we are noticing is the increases to both organic revenue as well as their operating profit, and as well as we're going to see now the EPS. It is slightly lower than the average, but overall these are fairly decent numbers for companies in the tobacco industry, which you could argue the industry as a whole is starting to slow down. Then when we take a look at essentially the new category market, we can see profitable in 2023, something they weren't anticipating yet. We can see over the last 3 years, in fact, it was negative. Expectation was to turn positive in around 2025. We also note here they have more than 30% smokeless revenue in 24 markets, and it has been increasing over the last few years. Very positive to note. And when we take a look at their strong generation of cash flow, and we notice how they also allocate that as well, a large chunk of that, as we can see over the last few years, has been through essentially the dividends, very large dividends in fact. We then also note in 2022 they did a share buyback taking up around 2 billion. And other than that, they also ways where they deleverage by buying back or in fact paying down a lot of that total debt. So looking very good. We're going to take a look at some of these numbers as well. In terms of their guidance, always important to understand. 2024, they're looking at low single figure organic revenue. When we're looking at 2026 and beyond, they're expecting 3 to 5% organic revenue growth, which is very positive. Yes, with other companies, we want to see a lot more, but also understand the type of industries that you're investing and have realistic expectations. We also want to point out they are essentially committed to 50% smokeless revenue ambition by 2035, and that isn't too far along now, so it will be interesting over the next few years to see how they are coming along with this ambitious target. So let's jump into the dividend safety. 45 borderline safe, market cap just under 70 billion. It is in fact a large cap company. Now, the borderline safe score was reaffirmed just a few months ago. Now, what this means is that it suggests there is a moderate risk of a dividend cut over a full economic cycle. So let's dive a bit deeper into the numbers to see where that is being pulled from. So in the last recession, 07-09, they in fact increased the dividend. They had plus 5% recession sales, significantly above the S&P average negative 12. They also outperformed the S&P negative 31, with the S&P coming in negative 55. In terms of dividend growth, remember on this channel, we kind of want to see at a bare minimum 3 to 4% just to keep up in line with inflation. They did an increase of 2% in February, not the greatest. 3% is okay at a very minimum level. Over the last 20 years, though, it has been a lot better. Remember, though, they do also pay a very high dividend, so you could excuse it by a few percentage points. And they are 1 year away from becoming a dividend aristocrat with 24 years of consecutive increases. In terms of dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. So we have one strong signal here of undervaluation. Another one here with the forward P 6.7, lower than the 5-year 8.5. And when we take a look, comparing it to the consumer staples sector of 18.8, British American Tobacco is sitting much lower. Just remember, we're not looking at any one of these models in isolation. We will conclude towards the end. In terms of the payout ratio, we do ignore the earnings, which is susceptible to manipulation by management through accounting. We focus on the free cash flow, below 80% for tobacco companies. Since 2018, it's been pretty consistently below that, although we do anticipate a small increase to around 67% in 2024, still lower than that maximum target. Free cash flow per share, try and invest or look at companies that do continually increase their free cash flow over the longer term. British American Tobacco have increased it by 3 times over the last 10 years, although we do point out it is anticipated to drop into 2024. In terms of sales growth, while 3 to 7%, remember that is the target. They have achieved 8% in 2022, but in the more recent year, negative 1%, so ideally we do want to see at a minimum 3 to 4%. When we look at their total sales numerically, though, we did look at this earlier, so just a different format. And one thing we do want to point out is, even though we did mention in 2022, as we can see here, they did some share buybacks, over the longer term, if you've been a shareholder since 2014, they would have diluted your position due to the increase in those shares outstanding. ROIC then, return on invested capital, remember a very strong metric, one of my favorites. You want to see above 15% for tobacco companies, just to give you faith that management are able to effectively allocate their capital. Now, it has been pretty low over the last 8 years, 12% in 2023, though that is positive. Hopefully it can start to increase to the likes of what we saw in 2014 and 2015. Now, in terms of the margins, very strong, significantly above 25% for the tobacco company industry that we look at. In fact, it has been increasing, so operational efficiency, 46% in 2023 as well. Same to be said for the free cash flow, in fact, in the mid-30s over the last 6 to 7 years, so that is very strong. Remember, you do want to be looking at companies that ideally increase both their top line as well as their margins. We then move on to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Below 3 is the main aim. Remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. And why this metric is so important that we always use it, it correlates to both not just in fact balance sheet strength, but also their dividend safety. 2023 it is below 3 at 2.65. 2024 pretty much there or thereabouts. This in conjunction with their low free cash flow payout, the dividend ultimately for now does look to be safe. No red flags that we can consider today. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the first valuation model. We have Graham's valuation, we have the stock ticker symbol, the earnings per share that we are expecting in 2024, the long-term growth rate, AAA corporate bond yield, to give an intrinsic value showing severe undervaluation, $46 with the market value of 31. Just bear in mind, we're not looking at any one of these models in isolation. We have the multiple valuation model, companies in a similar sector and size, the average P multiplied by the EPS of BTI to get an intrinsic value, again a second severe undervaluation signal. The third model is the dividend discount model. Now the average growth rate around 2 to 3%. Do bear in mind though, this is paid out in GBP sterling, hence why we have the FX rate changes. Forward looking, we've been very conservative, just 1% moving forwards, and we can see the intrinsic value does show another strong undervaluation signal. We then move on to the fourth model, the DCF, discounted cash flow model, with the free cash flow year on year. Average growth rate 14.62%. Again, we've tried to be very conservative, saying negative 6% forward looking, even with last year's 5% increase. We then get the discount rate of 8%, giving us the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get the intrinsic value, a fourth and final undervaluation signal. Now, the intrinsic value in today's episode is just the average of these four models, which comes to $48.57. Bear in mind as well, you can click on the pinned comment below to grab a copy of the valuation model to get to both intrinsic value and acceptable buy price of companies in your own portfolio and those on your watch list. Margin of safety then, for those that are new, we start off with 10% and we only execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. It is a buy up to 43.71 if you believe it meets that criteria, and then we keep going till it's near that current trading price. And we can see in today's episode it does have a very large MOS level, pretty much sitting at a 35% margin of safety based on the estimates and judgments that we ran through today, with a lot of them being very, very conservative. In terms of Wall Street and their expectations, well, over the next 12 months, they see this share price going up by 26% up to just under $40. Now, not as high as our intrinsic value, but with that yield of 10% or near there or thereabouts, you are also getting some implied upside of 26%. As always though, do let us know your thoughts in the comments below. Is this one you're looking to buy? Maybe one you're looking to sell, or maybe this is on your watch list. In my opinion, this is a very good stock if this is one that you are looking to get just for the dividends. 10% plus it does look like there is some very nice upside as well over the next few years. And as we saw from their forward guidance, they are expecting their top line revenues to get stronger and stronger as the years progress. So it all comes down to whether or not this does fit your investment thesis, and whether or not you believe for the tobacco industry, which some could argue is a dying industry, gives you enough margin of safety. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and we'll see you all on the next one.